What's up, everyone? In my last video, I explained to you the differences between ETFs, mutual funds, and index funds. And the biggest distinction between ETFs and mutual funds is the underlying structure, which ultimately affects the fees. And fees is one pretty big reason as to why you should choose ETFs over mutual funds, especially if you're in Canada and starting out. But what if you already hold mutual funds already? Don't worry about that. I got a workshop coming up that helps you turn your money-sucking mutual funds into a winning ETF portfolio. Details on that is in the link below. Canadians pay one of the highest mutual fund fees in the world. That's right. Throw that up there with postage, airline tickets, real estate, and cell phone bills. While we may have universal healthcare, not a cheap place to live. And there are a few reasons why mutual funds are more expensive than ETFs, but we'll get into that a little bit later. But for now, I want to explain to you the 3 reasons why you should be choosing ETFs over mutual funds. And of course, make sure you watch till the very end for that sassy bonus tip. The first reason being mutual funds are super expensive, and that's because of the way they're structured and how they were initially offered. Traditionally, mutual funds had a financial advisory component that was baked into the fee, which justified their high costs. But nowadays, people go into the banks and they buy mutual funds, they're still not getting the financial advice that they're supposedly paying for. And the banks certainly have not reduced that charge. Also, mutual funds are structured in a way such that when investors buy into the fund, their money is directly being invested in the underlying stocks or bonds or whatever assets the fund is supposed to be investing in. This also means that when an investor wants to take out their money, if there's not another buyer taking over that investor's position, the manager may have to sell some of the assets in the fund in order to give investors their money back. These are called redemptions. And redemptions may trigger capital losses or capital gains, which means investors of the mutual fund will be stuck with a tax bill, making mutual funds less tax efficient. And since most mutual funds are actively managed, there's a lot of buying and selling activity, and these activities will trigger capital gains, which means the investors are stuck with the tax bill again. Which brings us to the second reason you should be choosing ETFs, and that is because ETFs are more tax efficient. If an investor of an ETF wants to sell their ETF, all they have to do is sell it to someone else that wants to buy the ETF, similar to a stock. ETFs are traded like stocks, which means it doesn't require the fund to liquidate any of the underlying assets in order to give investors their money back. They just have to find someone else to take over their position. And on top of that, since most ETFs are passively managed, there's less buying and selling activity in the fund, which means less capital gains tax is triggered and passed on to the investor. You will only pay taxes when you sell the ETF as an individual investor. You wanting to get out of the ETF will not affect other investors that are still invested in the ETF. And finally, since ETFs trade like stocks, they offer way more flexibility for investors, especially beginner investors. Many of the mutual funds out there contain restrictions like minimum requirements or even subsequent ongoing investments or even penalties for early withdrawals. This means that if you choose to invest in ETFs, you can start with very little money and invest however much whenever you like. No minimum requirements or early withdrawal penalties. So even if you only have $50 to start with, you can easily start investing in ETFs. And here is your sassy bonus tip. If you're having reservations about switching over your mutual funds to ETFs, I want you to compare a mutual fund with a similar index ETF. For example, check out BMO's US Equity Mutual Fund versus BMO's S&P 500 Index ETF. As you can see, both funds are invested in more or less the same thing. Just check out the top 10 holdings in each of these funds. Yet, when we look at the performance from the last couple years, you can see that the mutual fund has underperformed every period since. So if you're unsure about leaving your bank because you trust them, at the very least, inquire about the ETFs that they offer. And still, some of the ETFs they offer aren't even the cheapest options out there. Companies like Vanguard and BlackRock offer very low-cost ETFs. But still, even if you do select an ETF from the bank, at least they're cheaper than the mutual funds you're currently holding. That's all for today. I hope you found this video helpful. Please hit the subscribe button below for more videos like this. And if you're looking for more resources like workshops and courses, check out the links below. I will see you later.